Welcome to holisticinvestment.in YouTube channel. We help individual investors like you to take a right financial and investment decision.
What are the different types of mutual fund schemes? Let us talk about that in this video. In one of our previous videos, we have talked about what is a mutual fund. If you have not watched that video, you can get the link for it in the description. Now let us begin with today's topic. What are the different types of mutual fund schemes? There are various ways to classify mutual fund schemes. They can be classified based upon the maturity. So based upon the maturity, mutual fund schemes can be classified into an open-ended scheme or a closed-ended scheme. First, let us understand what are open-ended funds or schemes. An open-ended fund is open for subscription and repurchase on a continuous basis. These schemes do not have a specified maturity period. So these funds are known for their liquidity. Now that you have understood what are open-ended funds, let's understand what are closed-ended funds or schemes. Unlike open-ended funds where you do not have specified maturity period, closed-ended funds or schemes have a specified maturity period that can range from 3 to 7 years. This fund is open for subscription only at the time of initial launch. So you can invest in this scheme at the time of new fund offer. Afterwards, you can buy or sell the units of the scheme on the stock exchanges where the units are listed. So basically, open-ended and closed-ended funds are differentiated by their maturity period. We have already seen how mutual fund schemes are classified based upon their maturity. Now we will see how mutual fund schemes can be classified according to their investment objective. Such schemes might be open-ended or closed-ended. Let's learn about these schemes one by one. First, let us look at growth or equity funds. The objective of equity funds is to provide capital appreciation over the medium to long-term period. Such funds typically invest a large portion of their corpus in equities and carry a high level of risk. If you are a long-term investor expecting growth over a long period, then you can invest in these equity funds. Second is income or debt-oriented funds. Unlike equity funds, income funds invest in fixed income securities like bonds, corporate debentures, government securities, and money market instruments. These funds are not affected by the fluctuations in the equity market, so they are less risky compared to equity schemes. However, capital growth opportunities are also limited in such investments. Third is balanced or hybrid funds. As the name suggests, balanced funds aim to provide a balance of both growth and regular income. Such funds invest both in equity and debt in the proportion indicated in their offer documents. If you are looking for growth without taking too many risks, then these funds are appropriate for you. These funds are also affected due to the fluctuations in share prices. However, as compared to pure equity funds, NAVs of such schemes are expected to be less volatile. Fourth is money market or liquid funds. These funds aim to provide easy liquidity, preservation of capital, and moderate income. These funds only invest in short-term instruments like treasury bills, certificates of deposit, commercial paper, interbank call money, government securities, etc. Compared to other funds, the returns on these funds do not fluctuate substantially. Therefore, these funds are suitable for business and individual investors looking to lodge excess funds for a limited period. Fifth is gilt funds. These funds invest exclusively in government securities. Government securities have no default risk. Just like income or debt-oriented funds, NAVs of these funds also fluctuate due to changes in interest rates and other economic factors. Last is index funds. Index funds replicate a specific index portfolio such as the BSE Sensitive Index, Sensex, NSE 50 Index, Nifty, and so on. This makes tracking your investments simpler and easy to understand. NAVs of such schemes would rise or fall by the rise or fall in the index. though not exactly by the same proportion, but may be due to some factors known as tracking error. Necessary disclosures in this regard are made in the offer documents of the mutual fund scheme. So these were the 6 mutual fund schemes based upon the investment objective. Thanks for watching. I hope this video was useful for you. If you have any doubts, then you can ask us in the comment section below. Would you like to attend insightful investment webinars? If yes, then we are organizing one very soon. The registration link for the upcoming investment webinar is given below this video in the description. If you have got value from our video, then don't forget to subscribe to our channel, hit that bell notification to keep getting updates for more such useful videos. That's it for today. Meet you soon. Bye bye.